Hi, Misty. How are you?
Good, how are you? Aloha, everybody. It's Misty Griffiths from Pacific One Mortgage, and we're a DBA of Bay Equity Home Loans. We are super excited to introduce a new loan product called the All-in-One Loan. It's an innovative loan product that you don't want to miss. And we have John Murphy that's going to present it to us, and he's hailing from Washington State. Take it away,
North of
John.
Seattle, in a rainy state. That's right.
It's
And we
raining
think
here
Misty,
in Maui, John.
yeah. Guys, Misty has been with us for quite a while, and we affectionately call her the queen of pay your mortgage off as fast as you possibly can. So we think she's the perfect host for this particular loan program. With that, I'm going to share my screen, Misty. We're going to walk through a little presentation here that's going to show the loan program. And let me adjust that so it looks a little better for you all. How does that look, Misty?
It's still the presenter view right now.
Oh, is that right? Not on my end, it's not.
That looks great.
That looks good? All right. So in line with our Ultimate Edge webinar series, guys, today we're going to talk about a loan called the All-in-One Loan, as Misty said there. A little bit about us. As Misty mentioned, we're Pacific One Mortgage. We're a branch office of Bay Equity. Bay Equity has branches in, I think, over 30 states now. Pacific One has branch offices in Washington and in Hawaii. Those are the states we focus on with our real estate clients. We do real estate related loans, as you can see there. But what we like to do is we love educating our clients as to their options so that you can make smart and informed choices with your lending, with your borrowing in your case. So here's our legalese. Guidelines, rates, programs change. Bay Equity is an equal housing lender. If you have any questions on this stuff, you should call us because things could be different tomorrow than they are today. So there's our legal disclaimer for you. So smart borrowing, I mentioned that to you. Different people have different situations. They have different resources. They have different goals. And hence, they really should have different strategies. So along with different strategies are different loan programs. Obviously, a first-time home buyer that wants to buy a home and does not have a down payment is probably going to have a different strategy than an investor that's working on their 20th property and building wealth through real estate. Hence, we're going to talk to those two different clients in a different manner and show them different options. And as our Ultimate Edge webinar series kind of embellishes here, I believe that wealth is not built with the best rate. It occurs by implementing the best strategy. Misty will tell you that we are problem solvers. And the problem that we're going to talk about today is interest. Interest expense in particular on a mortgage loan. And you'll see there a depiction of an amortization curve for a 30-year mortgage. In this particular case, it's a $250,000 mortgage. The rate is 5%. That yields a principal and interest payment of $1,342.05. And that's the payment you're going to make throughout the loan. But when you look at that graph, there are two things that pop out significantly to you. One is that the interest expense over the period of time is a lot of money, almost equal to the principal amount that's borrowed in this particular case. And the other thing that pops out really noticeable is that most of that interest is paid up front with the loan because that's how fixed rate mortgages work. You pay a large part of the interest on your first payment, and then a little bit less interest on the next payment, and a little bit less on the next payment after that, and over time you reduce it. But if you take a look at that, and you really understand it, that you'll be like this guy potentially who recognizes that halfway through his 30-year loan, he still owes 68% of the principal balance on his loan. Another way of saying that is he's paid off less than a third of the principal balance after 15 years or halfway through a 30-year loan. So it seems like there might be a better way. And the better way we're going to talk about today is something called the all-in-one loan. As mentioned, we like to tailor our particular products and strategies to the best borrower, and the best borrower profile for this loan are people who have significant cash flow that they run through a bank account, and they want to pay off their mortgage fast and with no change to their budget. They just want to run money through a bank account. This loan is designed for people like that. I do want to mention one other thing for you while we're here, guys. You need a minimum of 20% equity in your home to do the all-in-one loan. It goes up to 80% of the value. It is available on second homes and investment properties. And if you're going to do an investment property, it goes up to a maximum of 75% of the value, and it may be lower than that, depending if you're getting cash out and things like that. So in other words, you do need some equity in your property to make it work. So what is the all-in-one loan? It is a first position home equity line of credit. It is tied directly to a bank account so that when you make deposits into that bank account, they reduce the amount owed on the HELOC on a daily basis. And as you make withdrawals from the bank account, they increase the amount owed on the HELOC on a daily basis. The power of this really is created by the way that the lender calculates interest on the loan. And what they do is they calculate interest on a daily basis. That's significantly different, guys, than regular lines of credit would simply take an interest expense on the month for you on the balance that's there and calculates it out for the month. This one, every day, they calculate on a daily basis, and it's calculated after the principal balance, after all the deposits and withdrawals are netted out. So if you run significant money through your bank account, like we're talking about, and you reduce the principal balance on your HELOC that day, then the interest expense is a lot less than it was at the beginning of the day because they calculate the principal balance first, then do the interest expense. Once a month, they total all those daily interest expenses together, and then they assess the monthly interest to the line of credit. Misty, because this is such a significant feature, I'm going to say it in a slightly different way here, okay? Remember, the calculation of interest happens at the end of each day. It happens after all the deposits and withdrawals for that day have been taken into account. First, they calculate the principal balance on the line of credit. Then they calculate the interest expense. They do that every day. Once a month, it totals up, and they charge it to the balance on the line of credit. So obviously, the line of credit is a significant portion of this. I told you it's married to a bank account. Here's what the line of credit looks like. Just like a regular line of credit, it's there at a level basis for the first 10 years. And then, unlike other lines of credit, which on the 10-year basis, they amortize out for the remaining 20 years, whatever balance is there, and you make an amortized payment, but the line of credit portion goes away, and you no longer have access to it. This line of credit continues to be a line of credit for the remaining 20 years. It's just they reduce the available balance to you by 1/240th, which means 1 month out of 240, the remaining 20 years per month over that straight line. And that means you have the line of credit available to you even in year 20 kind of thing. And as long as your principal balance that you owe on it is lower than what's available below that line, you still have a line of credit equity that you can tap if you need to. So that's the line of credit. The other half to this strategy is the bank account, and the bank account that comes along with this is a regular bank account with debit cards and checks and online bill pay, bank transfers. The funds are insured by the FDIC or the NCUA, which is credit unions. You get online statements, monthly mail statements if you choose. There's a credit liaison and a customer care department available to you to chat with you. It is a high quality, good service kind of bank account. So you put the two together, and you look kind of like that. You have your banking married up with your home financing. The power of this really makes sense when you kind of take a look at the overall 30,000-foot view here. What we're doing is we're taking one of the biggest assets in your life, which is your income. Think of all the income that you run through your bank account over 30 years of having that loan, how much that is. Very significant amount for a lot of people, right? And instead of just depositing into a regular bank account where you may earn 0.1%, or maybe 0% or whatever your checking account is paying for you, what you're going to do is you're going to deposit it into a checking account which is married up to your line of credit, and you're going to reduce the line of credit, you're going to reduce the cost of that line of credit by the interest expense there. In effect, you're earning the interest amount on your line of credit with your deposit there. That shows 4%. As you know, the short-term rates are increasing. The Fed just increased rates one more time today by 0.25% kind of thing. So the rate you have in your line of credit could be higher than that. It is based on an index called the 1-month LIBOR index. Very common. You can open up the Wall Street Journal and see it there. And then there's a margin, and you have your choice of margins depending on what you pay up front. And that determines the total interest cost, rate, and expense with your line of credit. So you're taking one of your largest assets, your income, and applying it against one of your largest expenses, which is your mortgage on your home. In some people's cases, the biggest expense, and trying to get the best leverage on your income for that. Over time, it is significant, guys. This is how it looks on a monthly basis here. So on month 1, we made a deposit into our bank account of that amount. On the first day, that reduces the balance on your line of credit by the amount of that deposit right there. And then you have to live throughout the month. So as you're living, you're using your debit card, you may be paying bills with checks, you may be making transfers, whatever. As funds come out of your bank account, your line of credit balance is going to increase on a daily basis by the amounts that goes out. And then halfway through the month, let's say you get paid again, you make another deposit into your bank account. The balance on your line of credit drops by that amount of the deposit, and then you live for the rest of the month, and so the balance goes up depending on your living expenses. But notice, as long as you run a positive amount to your bank account and you don't spend more than you put in there, that the balance of your line of credit at the start of the month is greater than at the end of the month here, and you save interest. And then potentially the interest in that shaded portion right there for the first month of that line of credit. Second month, same things happens, guys. You make a deposit at the beginning, you live throughout the month, you make a deposit halfway through the month, you live again. Third month, the same thing happens again. And over 3 months, you can see that those shaded areas represent basically the interest that you have saved on that line of credit over a 3-month period. This really can add up, guys. As a matter of fact, here's a profile of people who have had the line of credit. This was done an independent analysis for the lender that offers this loan, and it was done in 2011, as you can see. And this lender does all kinds of loans. So they compared their all-in-one loan clients with other clients and found out that the all-in-one people allocated 3% more of their earnings toward retirement savings. They had 17% more go toward cash reserve accounts, that's short-term accounts like bank accounts and short-term stuff where you can pull cash in and out if you'd like to. They avoided paying tens of thousands of dollars of mortgage interest, and in some cases, they lowered their loan's principal balance by as much as 12% per year. Now, if you did 12% per year and you figure that out, in less than 10 years, you will have paid off your principal balance on your mortgage. It's very significant. And keep in mind, all the time they did that, they had that home equity line of credit available for either unplanned expenses or, as I say, for opportunities that might pop up. And if you want to buy another property or something like that, it's there for you. You don't have to refinance to get it. So how do you determine if this line of credit is the thing for you? Well, there's a simulator that we have available to you online. And you go to that simulator. This is the first screen you're going to see. You're going to put in some basic information. It's going to ask if you want to compare the all-in-one loan to a new loan. So if you're thinking about refinancing right now, does it make sense to do a 30 or a 15-year fix versus the all-in-one loan? Or you could just compare it with your existing loan you have on your house right now, and we'll put in the right parameters there for that loan and see how they compare over time. So first page is you're going to put your value of your home. You're going to put the mortgage information in there. Second screen, you're going to put in your deposits. Now notice you can put in weekly or bi-weekly or all the way up to annual deposits. You have lots of options here. You want to be as accurate as you can be with all of this information, of course. If you have a spouse or co-borrower, they can also put in their deposits in the same manner, depending on how they do them. Third screen, you're going to put in your withdrawals. You have two choices here, guys. You can enter a percentage of the deposits, which is what this screen is set up for. Notice this borrower says that they typically keep 20% of their deposits in their account. So they spend 80%, in other words, of what they put in the account to live. 20% remains there. If you want to be more specific for your situation, you can click here where it says enter detailed itemization of expenses and put your actual expenses on a monthly basis in, and it'll probably be a little more fine-tuned for you. And then what the simulator is going to do is produce a result for you. It's going to show you the balance on your line of credit over time. It's going to show you the comparison of the amortization curve here for the other loan you may have gotten with the amortization curve of the all-in-one loan and how much interest expense you may be saving, how much interest you may be saving. And it's going to give you those numbers actually on the screen. Now, I know that some of you are really independent and you just want to go there yourself, and that's okay. So there is the website address for the all-in-one loan simulator. It's AIO, so it's for all-in-one loan.net. My experience has been, guys, we've done a few simulators here recently with this loan, and I would really suggest that you let us guide you on this. It can happen with a phone call. You can be on your end, we can be on our end. We can set up the simulator. You can see it at the same time we're doing it. You or us can input the expenses in there. What's important is that you're accurate with it in there, and that then you see the results that are accurate as well. And we can do it either way. We're just here for you if you'd like for that. So remember our thought: wealth is not built with the best rate, it occurs with the implementation of the best strategy. We think this particular loan for the right client is an awesome strategy. I kind of suspect that one of those people on the screen there probably invited you to this webinar. So if you have questions, reach out to whomever invited you. There's the email and phone numbers there for you, and we're happy to answer those for you. And now I'm going to go back and talk with Misty directly. Hi, Misty.
Hi, John. So I'm really excited. Okay, so we're basically merging your checking account with your mortgage account. Every time I make a deposit, it goes towards my principal, correct?
That's it.
And I noticed the beauty of this program, if I work a regular job, which I do, I have automatic deposits that go into my checking account. It works the same way, correct?
Yes, that's exactly right.
Is there any balloon payment?
Pardon me?
Is there any balloon payment? I believe
there is no balloon payment. No, nothing like that. No.
That's really exciting. Let's see. Do I have any other questions? Well, I do have to tell you that this program's been around for many decades. You know, John, it's been around, started out, I believe, in Europe, and then made its way to Australia and New Zealand, and it's very successful in Australia and New Zealand. Just about everybody does their mortgages this way, actually. And I found out about it back in 2004, and I believe they started in 2002 in Australia. Anyway, it's been around a long time, and I'm so excited that it's now here in America for us. I know that we are certified, so not everyone can give you this loan, folks out there. You have to be certified to do these loans. And I'm super excited because people are going to be paying off their mortgages a lot sooner. Do you agree?
Oh, absolutely. I've had some people that, one of my clients recently, their existing mortgages have a first and a second, we're going to be paid off in about 15 years. So they're, you know, kind of on the tail end. With this strategy and refinancing, that showed that they would pay those loans off in 9 years and save them a pile of interest over that time.
And the exciting part, like you said, this loan stays with you for 30 years. So once he pays off in 9 years, he has all this available equity that he can use at any time, correct?
Yeah. Now, understanding that after 10 years, it goes down, but it is available to you. That's exactly right.
Is there an annual fee?
Oh, that's a good question. I believe the annual fee is $65 a year. It's waived the first year.
Okay, great. All right. And again, it works just like a regular checking account. You get your monthly statements, shows your deposits, your withdrawals, like any other thing. You can use your debit card, correct?
Yes, that's right. Let me look and see if there's any questions from our people in the webinar here. Oh, that's a good one. All right, so this person wants to know, what about the effect of increasing interest rates given the Fed is increasing rates? Very good question. When you're on the simulator, guys, the 1 month LIBOR is the index. It assumes that the 1 month LIBOR is going to go to the average of what the 1 month LIBOR has been for a number of years now. And I can show you what that is, and I think you might be able to even see it on the simulator. I can't remember that. So it doesn't assume that the worst case for the 1 year LIBOR, but it assumes that it goes to what is the norm for the 1 year LIBOR over a long period of time, which is probably the most accurate depiction you can have. Currently, the 1 year LIBOR, although it's increasing, is still lower than the norm. So when you do the simulator, you're going to get that result, which is reflective of a worse situation. So that's good. How long does it take to get this loan? About the time of a regular mortgage. It requires an appraisal, unlike some HELOCs where they just do an automated appraisal and all of that. This loan does have regular closing costs with it. You can pay 0 points, you can pay more than that, and that impacts your margin, so that impacts your rate for the life of the loan. And it takes about probably 30-ish days to refinance a loan of this nature. What kinds of banks? Yeah, so this person wants to know who the lenders are. I don't have the exact lender names. I believe there are 3 or maybe 4 major lenders now, banks now, that are working with this lender to offer bank accounts for you. They're all online kind of stuff. So it's not the bank you're going to go out to typically on the corner. You want to know that. Most of your banking is going to be done online with this particular lender. But remember, they do have the customer liaison available to you. So there is somebody you can call and actually talk with if you have questions on your account. So that's good.
And everybody does online banking nowadays. I mean, rarely does anybody.
It's pretty normal.
I mean, now you snap a picture with your phone to make a deposit. You know, it's crazy.
Right. This person wants to know, what about Hawaii? I guess I didn't specifically say that. So Misty's here because she's so excited because this one was available in 48 states for a number of years. And I think it's just this last year that they brought it over to Hawaii. So it's now available in Hawaii on first and second homes. And I believe on investment properties too, Misty. Do you know that?
Yes, it is.
Good. All right. I don't see any other questions, Misty, from the web in our audience right now. Anything else?
Yeah, I'm just super excited. You know, for years I've been teaching how to pay off their mortgage quickly in under 10 years or less with their existing mortgages, and it became complicated because you had to do a line of credit off to the side, and you know, you had to really do your own accounting. This makes life super simple. Everything's merged together the way they've been doing it for years in Europe and in Canada and in Australia and New Zealand, and we finally have it available now in America, and everyone should be getting on this program. It's
I would qualify that with everybody that qualifies should get this one.
Right.
Yeah, we're happy to check it out. Answer any questions you have, guys. Do the simulator with you. If it works for you, great. And if not, not a problem. It's just worth it, probably exploring at least.
And you know, if you have questions, we're available. Give us a call, and we can walk you through on a private basis on where you're at.
All right. Misty, thanks for hosting today. It's great to hang out with you.
Thank you. I'm excited. And stop bringing us all the rain from Washington. We want our sun here.
We can't promise anything right now. We want some of your weather.
Well, aloha. See you folks all later.
All right. Bye-bye, Misty. Thank you.